Welcome to our next lecture, How to Analyze and Interpret the Financial Statements. In this lecture, you will learn how to distinguish between horizontal and vertical analysis, how to compare financial statements between the companies and within the industries, how to explain the calculations of basic ratios, and you will learn the limitations of financial statements analysis. Let's start with the introduction to financial statements analysis. We will look here more on the analysis issues than on how to prepare the financial statements. Let's start with the reasons. Why do we need financial statements analysis? Basically, we are answering several questions in this analysis. And the first one, the main one, is how do we know if the investment in the company will provide a required rate of return? This is the main question which investors ask themselves. And they will basically make their decisions based on the results of such analysis. The next question is how do we assess whether a loan or trade payable will be repaid? We should be able to understand our perspectives. The next question is how to be sure that the company is consistently approaching its goals. And in this sense, we will say that financial statements analysis really helps in achieving goals by the company. And finally, how do we find the causes behind performance and how that performance links to the company's strategy? Let's distinguish the financial statements analysis. And we will start with financial analysis terminology. It basically represents the process of examining a company's performance in the context of the industry and economic environment. This is done in order to arrive at a decision or recommendation. This actually depends on the goals. Now, financial analysis can be represented within three main sides. First, it helps us to evaluate whether we are able to earn a return on our investment. Second, this return should be equal to the cost of capital, at least equal, or even exceed it. And third is that the company should be able to generate enough cash in order to meet its obligations. Now, in financial analysis, we usually start with the information which is contained in financial reports. Basic financial statement analysis usually provides us some foundations which enable the analysts or users of these results to better understand other information which was gathered from research beyond the financial reports. But basic financial reports, as you already know, include audited financial statements, disclosures, and such disclosures are usually required by regulatory authorities and by Ifrs Foundation as well, and accompanying commentaries which are usually issued by the management and included in the final report. Now, what do we already know about financial statements? Let's have a look. We know that companies prepare financial reports at a regular basis, which means that they will issue their reports annually, semi-annually, or quarterly, depending on the requirements. Second, financial statements are the results of accounting process. And as you know, accounting process represents the records of the company's economic activities. And these records are done with applicable accounting standards and principles. And third, we know that financial statements are usually audited by independent auditors. Especially, this is true for the listed companies, or we will say those for which IFRS standards are in force. Now, let's recall what complete set of financial statements usually includes. As you know, the complete set will include a statement of financial position as OFP or a balance sheet, a statement of comprehensive income or income statement, a statement of changes in equity, and a statement of cash flows. And all of those are quite important in our analysis. Why? Well, first, balance sheet, as you know, portrays the company's financial position at a given point of time. And basically, we can say that balance sheet is a snapshot of financial position of the company at a point of time. The statement of comprehensive income and statement of cash flows will present different aspects of company's performance over a period of time. The statement of changes in equity provides additional information regarding the changes in company's financial position. And in addition, the accompanying required notes or footnotes, which we spoke beforehand and which are issued by management, usually are considered as an integral part of a complete set of financial statements and should also be taken into consideration while making financial analysis. Now let's look at the balance sheet and income statement, and let's compare the basics of these financial statements. First of all, as we said, balance sheet is a snapshot of the company's assets and liabilities at a given point of time. That's just the same. On the left side, you have assets. On the right side, you have liabilities. Or you can have vertical balance sheet where you have assets in the top of your report and liabilities in the bottom. Now, assets will be listed in order of decreasing liquidity, which means that less liquid assets will begin our report, will open our report, and will be placed in the top of the balance sheet. Now, cash, as the most liquid asset, will be positioned in the bottom of our balance sheet. We should also recall the balance sheet identity, which is represented as basic accounting equation, which is assets equal liabilities plus equity. Now, as for the income statement represents us the operations for a specified period of time. Remember the difference? Balance sheet is a snapshot at a stated point of time, and income statement represents operations for the period of time. So that is the basic difference. But also, what income statement tells us about is the revenues first, and then the deductions of the expenses for the stated period. Income statement will also follow matching principle, which assumes that revenue will be accepted and matched with the expenses which are required to generate the revenue. Now, cash flow, another important financial statement. The cash flow is one of the most important pieces of information that a financial manager can derive from financial statements. And cash flow statement represents us a statement that summarizes sources and uses of cash. In this statement, we will see where the cash comes into the company and where it goes. The changes in financial statement of cash flows will usually be divided into three major categories: operating activity, investment activity, and financing activity. Remember these three different activities represented in cash flow from the previous lecture? Operating activity usually include the net income and changes in most current accounts. Investment activity includes changes in fixed assets, and financing activity includes changes in notes payable, in long-term debt, in equity accounts, as well as in dividends. In the statement of cash flows, we can represent the equation of the cash flow from assets into versions. The first equation shows us how the cash flows from the firm and how it is divided among the investors who financed the assets. As you see here, CFFA equals to the cash flow to creditors plus the cash flow to stockholders. The second equation in the cash flow represents us how the company receives from its assets. And this is a very important equation to remember. We will come back to it later on, and we will use it again when we do our capital budgeting analysis. Here, basically, we want to base our decisions on the timing and risk of the cash flows which we expect to receive from a project. And you can see that here CFFA will be equal to operating cash flow less net capital spending less changes in net working capital. Now, standardized financial statements. It is an important part to remember that in financial analysis, we will not only use just normal statements, normal financial statements in their basic form. Often, we use standardized financial statements. What do we mean when we say standardized? We represent balance sheets and income statements by computing all accounts as a percent of total assets or as a percent of sales in case of income statement. Now, the standardized statements will make it easier to compare financial information, particularly as the company grows. These types of statements are also useful to compare companies of different sizes, particularly within the same industry. In this section, we will focus our attention on analyzing of the financial statements rather than on its preparations. We will speak about the limitations of financial statements analysis. As you know, we have no ideal analysis basics, and we can say that there are limitations for each version of analysis. And limitations of the financial statements are also should be considered by the analysts. Well, let's start with the analysis which relates to measuring against the benchmark. We understand that such analysis will concentrate on companies' historical performance rather than on current position and market values. The measuring against benchmark will also help us to look at competitors' performance and analyze it in regard of the achievements of our competitors. And market expectations, this is also an important part, an important version of analysis related to the benchmarking. There are many relationships between the financial accounts and between the expected relationships from one point in time to another. And in these terms, ratios are quite useful to express these relationships. Well, ratios, formulas and names differ from author to author, from analyst to analyst, and there is no any comprehensive list which one person can follow and say, well, I know everything about ratios. No, you will come across with different definitions of the same ratios first, and different versions of computing the ratios. Thus, the number of the ratios which can be created is almost unlimited, and it all depends on your goals, on your even fantasy. Now, why ratios are useful? Before we go to the limitations part, let's think about this. What we understand under the ratios? We understand some items which are divided one by one and which can be represented as the part of each other. So we will say that ratios are relatively easy to compute. The ratios will also facilitate comparisons across companies of different sizes and will allow us to identify trends, shifts in critical relationships. But let's now look at some limitations. As I already said, most of the ratios are computed based on historical information, which means that they have almost no relations with market values. The second limitation is that there are different sets of ratios, which may provide conflicting signals, especially when you are comparing results of the analysis provided by different analysts. Judgment is applied in the interpretation, and the next is that the use of alternative accounting policies, which means that company may have changes in the policies and creative accounting practices, this happens in the companies, will reduce the usefulness of ratios. Finally, most popular ratios are based on numbers from the statement of financial position, and therefore will be measured and presented at a single point of time. The most important risk or danger associated with ratios is the tendency to focus on ratios without attempting to gain a proper understanding of the company, which means that most of the analysts, they just mechanically do the computations. But to make the ratio analysis useful, you should understand why you are doing that. Financial analysis cannot be brought down to the monitoring of a set of figures. You should understand your goal. We will now look with you at ratio analysis, liquidity ratios. Ratio is a relationship between two numbers of the same kind. For example, if there are 2 apples and 3 oranges, the ratio of the number of apples to the number of oranges will be 2 to 3. A financial ratio is a measure of the relative magnitude of 2 selected numerical values which are taken from companies' financial statements. But instead of apples and oranges, we will have financial statements. To perform a comprehensive analysis, we will use qualitative information about the company and we will consider it in the ratios. For example, one business may have a completely different product mix than another company, even though both operate in the same broad industry. Now, how to determine how well one company is doing relatively to another? Or how to identify whether key indicators are changing. We will compare ratios to the average industry ratios. To determine trends in the company's performance, ratios are often compared to past years' ratios of the same company. Now we will look at several types of ratios. We will start with liquidity ratios, which represent short-term solvency. We will then move to financial leverage ratios, which are long-term solvency. The turnover ratios go right after that and relates to the asset management. Then we will look at profitability ratios and market value ratios, finally. Now, short-term and long-term financing strategies will both have their advantages. The advantage of short-term debt, under the short-term debt, we usually understand the debt which is repayable within 1 year of the balance sheet date. And the main advantage of such debt is that it often does not require paying interest payments to the creditors. For example, if you look at accounts payable, they might not require payment of interest if they are paid within the first 30 days, while they are outstanding, right? The short-term debt also has its disadvantages. The payment will be required within at least 1 year, and often sooner. Here, interest rates on short-term debt are often higher than on the long-term debt. Compare loan provided for 6 months to the loan provided for 5 years. Which one will have the lowest rate? Now, what is liquidity? We start with liquidity ratios. We understand an increase in the proportion of short-term debt, which is more risky, and we start with this analysis because it must be renewed and therefore will be regenerated more frequently. Under the liquidity, we understand the ability to pay current liabilities, implying a short-term perspective, as you already know, which is within 1 year period. Now, liquidity ratios include several types of ratios which are often used by most of analysts. And you will definitely come across with these ratios in most financial analysis. We will start with current ratio. Current ratio measures the adequacy of the company's current assets to meet current liabilities. And this is just current assets over the current liabilities. So current assets can be easily taken from the balance sheet as well as current liabilities. The higher ratio will usually indicate high level of liquidity, which means that company has more liquid assets. The greater ability to meet short-term obligations. Here, rising receivables due to the delays in the receipt of the amounts due from the customers will be also a good signal to act. The company might also be increasing inventory levels or accumulating high cash balances. A relatively low ratio will indicate us that in this company the level of liquidity is quite low, which means that company has more assets which are not that liquid. The greater reliance on operating cash flow will be represented here, and the greater reliance on outside financing. Traditionally, a current ratio of those two was often regarded as safe. More recently, ratios of closer to 1.5 are increasingly being regarded as acceptable. Now, quick ratio or acid test ratio. This ratio will measure the relationship between current assets, excluding inventory, and current liabilities. The numerator here specifically excludes inventory, which is deemed to be the least liquid of all current assets, right? Inventory is something which company holds for more than 1 year. That's why we do not include it in our analysis here. In this sense, the furthest turning into cash will be delayed if we include the inventory in these calculations. Now, such ratio will provide us more conservative assessment of company's liquidity. The level which is typically expected to meet is somewhere in the range between 1 to 0.7. Now let's look at the solvency ratios. We will now look at solvency ratios. First of all, what is solvency? Under the solvency, we usually understand the company's ability to meet its long-term obligations. Remember, the definition of long-term obligation usually refers to the obligations which exceed 1 year period. This ratio may be expressed in two main ways. First, debt-to-equity ratio, which is debt over the equity, and debt-to-capital employed, debt over the capital employed. As you may understand, all these numbers can be easily get from balance sheet and income statement. The characteristics of highly geared business lay in the following areas. First of all, the company which is highly geared has lower risk which is faced by providers of debt, which means that company will be able to attract more funding via issuing debt instruments. Another issue is there is tax deductibility of interest payments. When you issue a debt, you can assume that the taxes might be deducted in accordance with the interest payments. Next, there is lower weighted average cost of capital levels. Well, weighted average cost of capital is just the WACC, which you probably heard from your previous courses in finance. The higher levels of return on equity in periods when revenue and profits are grown will also be represented and will characterize highly geared company. Unlike dividends on shares, interest on debt has to be paid irrespective of business performance, which means that providers of debt will be first in line to get back their money. Highly geared companies, therefore, will face a greater risk of insolvency. Limits of the solvency fall into the area that company might not be able to take on additional debt at a reasonable cost. Now, a high level of gearing will typically be considered more common with companies with relative stable earnings. Most providers of debt financing will usually favor borrowers who are able to provide their debt payments with collateral. And collateral, it is just the ability to pay the debts and interests by selling the assets. We will next look at profitability ratios. Let's now look at profitability ratios. And this type of ratios is very popular among the financial analysts. Let's have a look. Well, first of all, you can see a long list of the ratios which are typically used by analysts. We will be using this type of these type of ratios to analyze operating activities of the company. And profitability ratios will compare various expenses to the revenues and will help us to measure how well the assets of a company have been used to generate revenue. Now, profitability ratios will be divided into seven main ratios. Those are gross profit margin, operating profit margin, net profit ratio, sales to total assets ratio, return on total assets ratio or ROA, return on equity ratio, ROE, and return on capital employed or ROCE. The profitability ratios usually start with gross profit margin ratio. The gross profit ratio will indicate us the percentage of the sales revenue that is left to pay operating expenses of the business, creditor interests, and income taxes after deducting cost of goods sold. And here you can see that this ratio will indicate the percentage of revenue available to cover operating and other expenses to generate the profit, which is just gross profit over the sales revenue. The next type of ratios is gross profit margin. The gross profit margin will help us to understand combinations of higher product pricing and lower product production costs. This ratio is very important to be used while company wants to compare inside itself within the company, and when company, especially when it is comparing gross profit margins, which usually rarely make sense across different industries, but are used within the companies. Even a small decline in such percentage can affect net income significantly. And since the gross profit is a large component of the income statement, we can see that changes in gross profit should be investigated as those will impact future financial performance. Now, operating profit margin. The analysts should differentiate between the effects of one-off events and those which are likely to recur. Analysts typically compare changes in operating profit margin to those in gross profit margin. This ratio takes into account all the operating costs, including one-off items as well, which can be represented as operating profit over the sales revenue. Now, this ratio, operating profit ratio, measures a relative change in these other expenses. What is more, this ratio will indicate us the percentage of sales revenue which is left to cover interest and income taxes expenses. Of course, after deducting cost of goods sold and operating expenses. The next type of ratios, profitability ratios, is net profit ratio. The net profit ratio is the percentage of sales revenue retained by the company after payment of operating expenses, interest expenses, and income taxes. This ratio represents us an index of performance that can be used to compare the company to others in the same industry, and is usually expressed as net income over the sales revenue. We should mention here that this ratio will help us to recall that revenues are generated from a business assets holdings, right? The financial strength and success of a company depends on the efficient use of the assets which company holds. An analysis of an asset and investment decisions will be made by calculating such ratios as net profit. Another type of profitability ratios is sales to total assets ratio. And this ratio will help us to answer the main question of each analyst. Are sales of the company adequate in relation to its assets? This ratio helps us to answer this question by establishing the number of sales earned for each invested amount of money in assets, and can be represented as net sales over the average total assets. Now, a low ratio in relation to other companies in the same industry might indicate us an overinvestment or might indicate an inefficient use of the assets by the company. On the other hand, higher ratio in comparison to other companies would be a positive indicator. Now, return on total assets ratio, or ROA. This ratio is designed to measure the efficiency with which all of companies' assets are used to produce income from operations. And it is usually represented as income from operations over the average total assets. Here, low ratio in relation to other companies in the same industry may indicate us overinvestment. The next ratio is return on equity ratio, or ROE. It is important to stress here the significance of the accounting policy choices made by the reporting entity with regard to its non-current assets. And it is even more important when we are computing ROCE or ROE. Now, return on equity ratio will help us to measure the return to shareholders, or, in other words, how much net income was earned for the owners of the business. And we will compute it by dividing net income over the average equity. The return on capital employed. Well, here the ratio which measures the profits which a company earns on all of the capital that it employs, both in equity and in debt. The numerator here is typically associated with earnings before interest and taxes, which is EBIT. But for simplicity, we can represent it as profit over the capital employed. The capital employed is typically defined as equity plus interest-bearing debt, or the difference between total assets and current liabilities, which goes from the balance sheet equation. We will now look at market value ratios. Now we will consider the next set of ratios, market value ratios. And this set will usually include earnings per share, EPS, price earnings ratio, or PE, and dividend yield. Well, these ratios are completely different from those which we have considered beforehand, because in these ratios we will use market estimates, not just those which are included in the financial statements. The earnings per share, let's start with this ratio. This ratio will measure the efficiency on shareholder returns on a per share basis. And as you see, we'll consider the number of common shares outstanding in the computation. Well, here we will look at the amount of net income earned in a year, and it will be divided by the number of common shares outstanding. This is done to establish how much return has been earned for each outstanding share. Earnings per share is usually quoted in financial markets and is disclosed on the income statement of publicly traded companies, which means that you can come across with this ratio almost in every report. Next ratio, which we will consider, is price to earnings ratio, or PE ratio. Basically, this is a price at which a common share trades on the stock market. And perhaps it's the most important measure of company's financial performance. But of course, it's arguable, as everything in finance. Well, this price-to-earnings ratio measures the relationship between the current market price of company's stock, and the level of earnings per share, or EPS, which is generated by the business. Now, we can compute it by dividing market price per share over the earnings per share. The market price of one share will reflect the opinions of investors about a company's future value compared to alternative investments. This ratio is used as the basic indicator of the market's expectations and will be the favorite ratio of finance analysts, because it helps us to predict the company's future performance. Well, of course, we cannot tell for sure how the company will perform, but this ratio will help us to come more closely to that. Now, dividend per share, or dividend yield. This ratio indicates us how large a return in the form of dividend can be expected from an investment in a company's shares. And this is actually quite important for such investors who look to maximize dividends revenue from share investments rather than realize an increasing market price of the share. Remember that investors will gain their profit in two ways. First, by increasing the share price, and second, by getting the dividends paid. This ratio will represent us such calculations as dividend per share over the current share price, which is also connected to the market valuations. In this part of our lecture, we will consider calculations of main ratios, which are activity and liquidity ratios. We will use Apple company financial statements for 2020, which will be provided for you in additional materials to this lecture. I would like to start with the basic ratio, which represents us the net profit margin. And the basic formula for it, net profit margin will look like net income over the revenue. Now, as you open financial statements for Apple company for 2020, you might not necessarily find their revenue, but this will be instead represented by total sales. You will find their net income, and it is for Apple company for 2020 is just as follows: $57,441 million. And we will divide it over the total revenue for our company, which is for 2020 $274,515 million. Now, as you can see, net profit margin for Apple is 0.21. And this represents us first of all, we need to understand that this is an indicator. This is not an answer to our question, right? This is something which should be interpreted. And this is true for all the ratios. we have found the profit relative to the revenue, right? So we have calculated net profit margin by dividing the net income or net profit over the total revenue. Let's now look at some types of the ratios, which are activity ratios. And we will start here with inventory turnover. Inventory turnover. The inventory turnover can be calculated as cost of sales over the average inventory. Now, the cost of sales will be represented in the income statement or statement of a comprehensive income and can be found in additional materials to this lecture. Now, the cost of sales for Apple company for 2020 is 169,559 over the average inventory. Now, when we say average, we mean that it is something which requires further calculations. In each statement, in each income statement, you will particularly have information for 2 years. In our case, this will be 2020 and 2019. Inventory for 2020 for Apple company is 461, whereas the inventory for 2019 you can find equal to 4,160. Now we need to find average inventory, which will be just adding both figures and dividing into the number of figures. And in our case, we will get here 8,221. As soon as we have 2 figures for 2 years here, we should divide it over 2, and that's how we will receive 4,110.5. And this directly goes to our calculations for the inventory turnover to the denominator, 4,110.5. Now, what you should get here will be 41.3. What does this mean? This ratio shows us that how the company utilizes its assets. And basically, it means that it takes approximately 41 days for Apple company to sell its goods, to sell the inventory. When we have found the inventory turnover, we can now move to the days of inventory on hand, or DOH. Days of inventory on hand will show us for how long company holds its inventory, its goods on hand. And this can be simply found by dividing the number of days in the year, 365, over our inventory turnover, 41.3. And this gives us 8.84 as DOH, which means that the Apple company holds its inventory for approximately 8 or even 9 days, if rounded. We will now look at the receivables turnover. The next ratio will represent us the receivables turnover, which is found by dividing the revenue over the average receivables. Once again, we will be looking here at our average figures. Now, what we have for Apple company for 2020 is that we have revenue of 274,515 as revenue. And as for the average receivables, let's look at receivables in 2020, which was reported as 16,120, and receivables of 2019, which was reported as 22,926. Now we are looking for average figure here, and average receivables can be calculated as the sum of these two figures divided over 2. And it should be 19,523. And this is where figure goes, 19,523, giving us the result of 14.1 if rounded. This is actually the average amount of days when company receives money for the sales. We can therefore find another ratio here, which is days of sales outstanding. And days of sales outstanding will be calculated just as we have calculated DOH, but with using our receivable turnover figure. It is 365 days over 14.1. And here we get 25.96 days on average. In activity ratios, we need to consider also another portion of important ratios, which are represented by payables turnover, and payables turnover will be calculated just as receivables, but in reference to the payables. Payables turnover can be calculated as purchases over the average trade payables. For our company, for Apple company, in 2020, our purchases can be found as 169,559, and this should be divided over the average trade payables. Now, to find the average trade payables, we need to look at trade payables for 2020 in our report. In our report, it is 42,296, and trade payables for 2019, which was 46,236. Now, as we add them together and divide over 2, we will get an average resulting with 44,266. And this is the figure which we will use in our formula. Right here, 44,266. And this will give us 3.83 days turnover of the payables, which means that Apple company will receive money for its goods in average in 3 days. Now, number of days payables. Number of days payables can be easily found by dividing the number of days in the year, in the period, over our found payables turnover, which is 3.83. And we get here 95.3 days for payables, which represents us number of days, average days for which company pays its liabilities.